Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Frank Doyle, and Frank is an attorney and founder of Wealth Plan, a law firm specializing in estate planning, estate and trust administration, and estate and trust litigation. He's been practicing law for about 34 years, and he's certified by the California State Bar as a specialist in taxation law and probate estate planning and trust law. So first, Frank, thank you for being a guest.
Well, thank you for having me. So, you've invited me to talk about one of my favorite subjects.
Oh, boy. So folks, what we're going to be talking about today is preserving family assets using a family limited partnership or LLC. And before we get started, I want to caution you that we're just covering a few highlights of actually an enormous area of tax law and rules related to estate planning using family limited partnerships and limited liability companies or LLCs. And so this is just a bare starting point to learn about some of the issues, and you should get qualified tax and legal advice. This discussion is going to focus on California law. Frank is a California attorney. I'm a California CPA. The rules will vary somewhat for other states, so just be aware of that. Okay, Frank, let's get into our questions. And folks, also, this is big, so we may not get through all of our questions. We're going to do our best. So first, what's the status of the federal estate tax, and why should substantial individuals still be concerned about avoiding estate tax?
Well, this whole year we haven't had an estate tax, and at the beginning of the year people thought, well, gee, maybe they'll make it retroactive, but that hasn't happened, and it won't happen. But what will happen is the repeal of the estate tax is set to expire at the end of this year. So
okay, so we're recording this on November 16th, 2010. So in case you watch this at a later time, for frame a little bit for the time.
Right. So on January 1, 2011, the estate tax rears its very ugly head again, and it comes back with a vengeance, because what happens is it comes back with only $1 million exemptions and very high rates. In other words, the rates are going to range from 45% to 55%. And that's quite a big deal, because in 2009, prior to the expiration of the estate tax, the rates were proposed to be 45%, and the exemptions were $3.5 million per person. So between a married couple, they could exempt $7 million of assets from the estate tax. Now we're down to you only can exempt, if you're a couple, $1 million each or $2 million. So a lot of people who have, estates, real estate holdings, for example, their estates are going to be exposed to an estate tax, which is going to make the kind of planning we're going to be talking about more important than ever.
Okay. Frank, when we're talking, you can just go ahead and look at me as the best.
All right.
Okay?
Okay.
All right. And, I mean, part of this is we just don't know what's going to happen. There's been a discussion, that we may see a higher exemption again, but this is a negotiation that's going to happen with the next Congress and so forth. So it's a really tough environment to plan in anyway.
It is, but if there's no action, then the tax, comes back. And,
big time.
And we don't see any sense of cooperation, at least in the short term, as a result of the elections between the Republicans and Democrats. And when you don't have that cooperation, then what's on the books tends to become law. That's what happened in 2009, when everybody thought the estate tax would be extended for a year, $3.5 million exemptions, 45% rates, and everybody was prepared for that to happen, and then it didn't happen. The estate tax went away, and the same thing kind of is happening right now.
Yeah, so we'll have to see. Okay, now what is an approach, aside from conventional estate planning, that can result in a significant reduction of the estate tax?
Well, one of the things we have is when we're talking about, conventional planning, and our philosophy is estate planning is like building a house. And so the very first thing you want to do is have a good foundation plan. And that means having your living trust, utilizing the exemptions, maximizing the use of the marital deduction to the extent possible. It's part of a foundation. Then once that's there, then you can look at taking the next step, which in many cases involves establishing family limited partnerships. And where they're useful is where the family owns typically real estate that is being operated by the family, and they want to provide not only for some tax planning, but also for some succession planning. The senior generation typically is getting older, and they want to have a way to preserve these properties for the benefit of the entire clan going forward. And that's where you get into the more advanced kind of planning. And in this environment, where we didn't have an estate tax, people still set up family limited partnerships, not for tax reasons, but for business reasons. And as we're going to discuss, one of the big things that any viable family limited partnership has to have is a good business purpose. So we start there, the family. I think that get your foundation in, because that's going to take care of the first $2 million and that you have, and then you have to look to see what other opportunities there are to to do some more advanced planning, like the family limited partnership.
Okay. Now, one thing I should mention at this point is we're going to talk about this as family limited partnerships, but it can be a family limited partnership or a limited liability company that's family owned.
Well, typically what we do, and this is maybe a little bit peculiar to California law, but we have the limited liability will be the general partner of the family limited partnership. So the structure that we like is to have a limited liability company be the general partner, and then we have the the individual family members own percentages or units in the family limited partnership.
Okay.
And the reason we like that structure is because in many cases what we're trying to do is get people who don't have an active role in the business get some benefit from the real estate business. And so one of the things that structure allows you to do is separate the management, which is with the limited liability company, from the equity ownership, much like a corporation. And we find that structure works very well.
Okay. So why don't we talk for a few minutes about the benefits of lifetime giving?
Well, lifetime giving, the way the tax will be structured again starting January 1 when they bring the estate tax back, is there's a built-in advantage for lifetime giving. And what that is first of all, the gift tax is tax exclusive, whereas the estate tax is tax inclusive. And what that means is if a person makes a gift, they pay the gift tax on it. So not only do they get the underlying asset out, but they also get the gift tax out, provided they live 3 years. But that's a very important advantage that gifting has structurally.
So what we just said is, in essence, from an estate tax standpoint, you're getting a deduction for the gift tax because it's being paid out by, let's say, the parents or whoever that are making the gift.
Right. So the actual beneficiaries get a more powerful gift because of that. Now the other thing is this whole idea of fractionalization. If we have like let's say a $10 million apartment house, and we have we want to give 10% of it away. Well, the valuation rules are that 10% isn't worth $100,000. It's worth $100,000 less some sort of fractional discount, and that depends on the facts and circumstances. And those range from, I would say typically from 20% to maybe 40%. Now some people say, well, from 15% all the way to 75%. My experience is, we really are centering around the 30% mark, and then depending on the facts and circumstances, your discount will be, adjusted. So, and this is really kind of the power of discount leverage gifting, so that people can maybe take that $100,000 gift and, let's say, give it down to their the beneficiary at a gift tax cost of only $60,000.
So you give more for less.
Yeah, you give a lot more for less, and I think that's that's important when people want to get these properties down to their beneficiaries prior to death.
Okay. So how does fractionalization work?
Well, first of all, it's when the way the Internal Revenue Service has scrutinized this area, this isn't an area where you can skimp on valuations. You have to get really two valuations, like in the real estate area that I talked about. First thing is you have to get a valuation of the real property. So we need to know what the 100% is. Then the second thing we need to do is look at what's the interest being given. Are we given a co-tenancy interest? Are we given a partnership interest? Are we given an interest in a corporation? Or what's the value of the interest? And there are two discounts that are typically available in the family business entity arena. One is a lack of marketability, with the idea that if you have an interest in your family's limited partnership, you can't call your broker up and get it sold the next day. All right, it's not marketable. It's a family asset, and it's tied up in a family enterprise. The second thing is, if you're a 10% owner, well, you don't have much power. In other words, you can't, you don't have the 50% that's needed to control the operations or control who the general partner is, so you get a minority interest discount. So those two discounts are separate and distinct discounts, and they're that the combination is what results in some of these higher percentages. If we have a 15% minority interest discount and a 15% lack of marketability discount, well, you've got 30%. So that's kind of how the fractionalization works. But an important point is this needs to be done and proven by valuations. In other words, you have the real estate appraiser will appraise the property, then you have a business valuation person who will value the business interest and apply those discounts. They're two separate and distinct special valuations, and those are important. And the tax, if you do the appraisals correctly, the IRS has lost all the valuation cases. Now we're going to talk about where the IRS has won, in the structural area. But in terms of the idea that you're not entitled to a fractional discount or a minority interest discount or a lack of marketability discount, the IRS has lost over and over again. And so the tax court and then the federal courts have basically said, look, if you're giving a 10% interest, that's what you're giving. And we're going to value that interest. And so I think that's and so if you do your homework and you do it properly, it will withstand scrutiny.